Hello and welcome everyone to Insights from the PM's Desk. I'm Justin Plouffe, Deputy Chief Investment Officer for Global Credit at Carlyle. I am joined once again by Jason Thomas, Head of Research and Investment Strategy at Carlyle. Jason, thanks for being here.
Thanks for having me back.
So let's start with the topic on everyone's mind, tariffs. Now, across Carlyle, we have more than 200 portfolio companies, more than 1,000 lending relationships. How are our companies reacting to these tariffs?
What was so interesting when we went through the April data was that we didn't really see much in the way of impact from tariffs. It felt uncomfortable in some ways reporting that because we were expecting to see increases in prices, perhaps hiring freezes, big reactions to Liberation Day. Instead, what we saw is an economy that was growing at about the same rate as it was in the first quarter. We didn't see really any hiring freezes or any change in labor demand. And I think that when speaking to management teams to try to understand why this was, it's really the competitive nature of these markets. It's obvious, perhaps trite, to say that tariff-exposed companies operate in tariff-exposed industries. So in this case, many management teams really wanted to project a sense of normalcy. And a lot of that was because you don't want to have those very difficult conversations with your customers when you're pushing on price. You don't want to have those very difficult conversations with your suppliers who are trying to cut the import price if you believe that the tariff policy in place today is going to be quite different from the tariff policy in place 2 months from now. So it was just the sense that this impermanence of the policy that led people to essentially wait it out. And what allowed them to do that was, of course, record inventory accumulation. That started basically after the election. So if you looked at Q1, you had this enormous growth in inventories of components, parts, raw materials, other equipment that essentially gave companies 2 to 3 months, in some cases even longer, where because that was all acquired pre-tariff, there was no need from an economic perspective to increase your prices or cut back on your prices that you're paying for the imports. So eventually this will run out, but we've already seen that the tariff policy has changed quite substantially. And I think the adjustment's still coming. I don't suspect that we're going to see more and more months like this. But I think that this made a lot of sense. Again, to not have these needlessly ruptured relationships with the key constituents, customers, suppliers, when it may not be necessary.
Right. Now, equity markets have certainly agreed with that view. They've rallied and erased any losses from 2025. But do we still think a shock is coming? Is this really just a lag as companies work through the inventory they already had? I mean, are we Wile E. Coyote off the edge of the cliff, just haven't realized we've fallen yet?
I think that the key information over the past several weeks is the insistence from the U.S. perspective that their 10% tariff remain in that UK trade deal. And that's significant because what I think is going on here is a backdoor VAT. That this insistence on 10% tariff rates is a way to generate potentially sizable revenue. You could generate between $200 and $300 billion a year from those tariffs. And I think that revenue is designed to assuage fears from some deficit hawks in Congress who are worried about this very large tax reconciliation package. And so it's a way to say, don't worry about these unfunded incremental tax cuts. Don't worry about the extension of current law because we're going to be generating a lot of revenue from tariffs. So I think that purpose of tariffs is coming into view, that this is designed to raise revenue. So last year, the US imported, in terms of goods, the imports were equal to 11.5% of GDP. So if you have a 10 percentage point increase in that, just over a percentage point of GDP in terms of impact, that's actually very similar to in 2014, Japan instituted a 3 percentage point increase in its VAT, its consumption tax. That's applied to 40% of GDP. So that actually provides a pretty good template for what to expect. And generally, what we think is reasonable would be a 1 to 1.5% increase in the price level. That then leads to a pullback in consumption, this price shock, and then some modest weakening of labor markets in response to that. And I think that's, again, a shock is coming, but it's obviously greatly attenuated relative to the effective embargo that we had on China a couple of weeks ago, and relative to some of course, the extraordinarily high tariff rates that were unveiled April 2nd.
So in some sense, we could expect a reduction in consumption, On the other hand, tariffs, all else equal, will be inflationary. If you're the Fed, if you're Jerome Powell, what do you do in this situation?
Well, the Fed is a very dovish institution. Let's be honest. I always remember back early days of my career, 1998, where you had an economy that was, really performing better than I think in any of our lifetimes. You had unemployment below 4%. You had 3% productivity growth. You had a larger share of people employed in the population than ever before. And the Fed cut rates 75 basis points because a hedge fund failed. Mm-hmm. So this is an institution that they say they have a dual mandate, of course, and that is in the 1978 law. But because of the dual mandate, focus on inflation and the labor markets, whenever there is substantial weakening of the labor markets, you can count on the Fed to cut rates. And so if that does come to pass, if you have this pullback in consumption, weakening of the labor markets, unemployment going from 4.2 to say 4.5%, the Fed will cut rates. Now, because of that inflation, they have to be a bit more guarded. And I think importantly, they cannot preemptively cut rates. That, as we've seen, even in 2024, there wasn't really much of a deterioration. They cut rates by 100 basis points. That was preemptive. They wanted to get ahead of any deterioration in the economy. In this case, they can't do that. They actually have to wait to see genuine deterioration in the labor markets. But once they observe that, they'll cut rates one or two times, certainly.
Right. So from the perspective of an investment strategist, this is an incredibly complex environment with many new factors. And some would even say the end of 50 years of globalization. Yeah. How are you thinking about investing capital today?
Well, I think that beyond the revenue side, the other message from tariffs is that the administration would like to reverse some of the processes, not globalization per se, although that's certainly at risk, but there's an interesting fissure, you could say, between right now the U.S. manufacturing sector in terms of its share of GDP is relatively small, about 10.5% of GDP. The manufacturing capacity in the U.S. is about 1/3 of that of China. It's barely larger than India's manufacturing capacity, but yet the U.S. manufacturing sector in terms of market capitalization is far and away larger than anywhere else in the world, almost twice that of China, almost 3 times that of Japan. What explains that? Well, it's because manufacturers in the U.S. have increasingly focused on high value-added, high margin activities, product design, product development, especially branding. So you're in a situation that's really interesting because when you think about the trade deficit in things like smartphones, well, China's not sending us Chinese branded smartphones.
Right.
When you think about the trade deficit in apparel and athletic wear, Vietnam is not sending us Vietnamese branded sneakers. And so it's that kind of economic activity or industrial organization that is going to remain under pressure because this is effectively a tax on it.
Right. Well, interesting times, certainly a lot of changes and a difficult investment environment to navigate. Fantastic that at Carlyle we have resources like you. Always appreciate your spending time with us, Jason. Thanks to all of you for joining us on Insights from the PM's Desk. We'll see you next time.